Take stock of what the market is up to. What looked like a quiet start is still quiet. We're holding about 50 points higher on the Nifty, so that's looking comfortable. And the breadth as well, early days yet, but it's marginally only in favor of the advances. So 15,174 is where we're currently at when it comes to the Nifty futures. Where is it that we are holding at in terms of individual stocks? ONGC, Wipro, UPL, Reliance has dashed up about 2%. Titan is holding up about 1.7% ahead of its numbers. ITC looking good by about 1.7%. But under pressure, Tata Motors, SBI, Axis Bank, M&M, Bajaj Finance, JSW Steel, IndusInd Bank. These are the spots of red as we speak right now. And my screen has completely hung. I'm going to have to ask Nikuj to take over.
All right, let's now welcome on board the management of Vaibhav Global, Mr. Vineet Ganeriwala, who's joining us this morning. Vineet, good to have you with us. Now, let's talk about the festive season first and how that panned out vis-a-vis some of the previous years, the momentum that you're also seeing post that now.
So good morning to you and your viewers, and thank you for having me here. So Q3 was fantastic. So we reported another quarter of strong numbers, continued the momentum of earlier quarters. Usually in this quarter during the election time, we used to see some distraction in our TV viewership, but pretty strong numbers coming on the back of, despite the US elections, it's very, very heartening. So our retail revenues grew by about 30% year on year. EBITDA grew by 37% year on year. Margins expanded to 17% plus. In fact, on a 9-month basis also, the EBITDA margins expanded by 160% basis points. Cash 40% up to 166 crores. ROC 56% plus. Customers 33% year on year growth. So all in all round strong performance in all the revenue, profit and customer matrices. So pretty happy, pretty pleased with our performance in Q3.
Okay. With the UK again going under lockdown now, does that affect your sales, also the supply side? I mean, how much of an impact is that going to have?
So we are a digital player. So we sell through TV, we sell through web, we sell through marketplaces and social commerce. So in cases of lockdown scenarios, it only boosts up our sale further. So no problem of no any sales in such lockdown kind of a scenario. Talking about supplies, so we are a regional supply chain. So we have our sourcing locations in India, China, Thailand, Bali. Besides, we also source locally from US and UK. So we managed to smoothly supply various kinds of products to our customers, even during peak lockdown, during the peak pandemic period early last year. So when China was locked down, India stepped up. Later, when India was locked down, China and the other locations stepped up and continued with the supplies. So no concern as far as supplies are concerned. And in case of lockdown, the sales only grow further as we are a digital e-retailer.
Also, Vineet, wanted to understand how exactly have you managed to, stay slowdown proof all this time? Tell us about what's been helping you sustain the margins, for instance, despite having a bottle base which is, based on heavy discounting. Sales and margin outlook, if you could just highlight that for the fourth quarter and beyond, and whether you will continue to add on to your operational numbers or not.
So we are an omni-channel e-retailer. So we are present in TV, web, marketplaces, and social DR. So we engage with customers across all digital platforms. So which works for us. So in fact, lifetime value for an omni-channel customer is 10x than of a normal TV or a web customer. We are a deep discount player, which works in all kind of economic cycles, what you were also mentioning. So on an average, our average selling price is half of that of our competitors. So customer perceives a lot of value in our products. And with with this pandemic, the retail structure is also undergoing change, and customer preferences are increasingly moving towards these value-based purchases. Our business model is such that below the gross margins, a lot of the costs are fixed or stable in nature. Approximately 55 to 60% costs are fixed or stable. The rest 40 to 45% are variable, which grows in line with the revenue growth. But because of the large part of the cost being fixed or stable, we have a pretty decent flow through. In case of rising revenues, a lot part of that flows into the EBITDA, and we continue to see good operating leverage. Also, we are a vertically integrated player. We have our own supply chain. We produce our own fashion jewelry requirements and source the lifestyle products directly from the manufacturers in various Asia locations. So this enables us, on the one hand, to offer the products at a high value to the customer, but at the same time also maintain our gross margins, which we have been able to maintain through many years above 60%.
Okay. Your business is not very capex intensive, and we've chatted about this many times as well. Does it also then imply that whatever money you make actually gets added to your books, all the cash generation?
Yes, so we see a good flow through from PAT to free cash flow because it's not a heavy capital intensive industry. So our routine capex requirement is not much, and that is this is in spite of the various kinds of investments we keep on doing in the digital front. So we have been actively and consciously investing in digital, and will continue to do so. But the routine capex requirement is definitely not much. So the prudent capital allocation, the efficient cost management, the low debt structure actually delivers a very high ROCE, which is now crossing 56%. Of course, we want to invest in properties, in warehouse, in multiple warehouse locations in US. So whenever that happens, that will be a one-time capex. But other than that, it's a pretty moderate capex intensive industry.
So what is in store for a shareholder? More buybacks, more dividend? Because if you are doing a moderate capex, then eventually the cash which you're generating should be given back, or you will have to acquire something.
So we announced interim dividend in all the quarters. So all the 3 quarters put together for the current year, we have already announced interim dividend of about 17.5 rupees per share. And we'll continue to announce dividend every quarter going forward as well. We have laid down our dividend policy in which we stated our intent to distribute at least 20 to 30% of our free cash flows. This decision, and in fact, we may look at even distributing a higher share of our free cash flows. The decision would be actually balancing between the resource conservation for future growth areas and rewarding our shareholders. So if we don't find a better use for cash, we may look at even distributing higher cash to our shareholders. Last year, pretty much including the buyback and dividend, we distributed almost entire free cash flow for the year.
Vineet, the challenge for a business like yours is that we live in a very disruptive world. And there are a lot of portals which were very big, or aggregators which were very big. Suddenly AI and technology just knocked them out of business, whether it is in the jewelry space or whether it is in the aggregation space. How are you planning to create a moat around your business so that in today's disruptive world you survive and you grow?
So like I mentioned, so we are an omni-channel player. So we are present in TV, web, digital, and social. So this unique TV and web combined, the platforms combined, gives a unique shopping experience to the retailer, which is unmatched. In fact, what we also see is that lifetime value of our omni-channel customer is 10 times than that of a pure TV or a pure web customer. We continue to invest in digital. We continue to invest over TV. So we are investing in low channel positions. And in the TV, in fact, the entire selling is done through a content and a story-based telling. So we continue to be aware of the changing market scenarios. We have a high velocity innovation team in place, which not only spots customer trends, understands their changing needs, but also takes advantage of that by reacting and supplying quickly to them what they need. So all in all, we seem to be very well poised to take advantage of all the changing retail dynamics, and we'll continue to do so.
So eventually, where do you think your return on capital and return on equity would settle? One side is growth, and second side is you'll keep on giving cash back. If you keep on giving cash back, your return ratios will not go down, because just for the benefit of our viewers, if a company is generating a lot of cash and if they're not giving cash back or not acquiring something, the return ratios they get challenged. Okay, over to you. Where do you think your ROS and where do you think your return ratios will settle?
So we don't give any guidance for the return ratios. What we have definitely seen in the last many years is it keeps on expanding. And our business model is such that unless we say maybe acquire a new company or invest heavily in our future growth areas, this should keep on expanding. So we don't want to give any guidance for the return ratios, but with the business model, we are pretty confident of expanding it on a continuous basis.
All right, Vineet, thanks so much for joining us this morning and taking us through the business and how it's going in great detail.
Thank you very much. Thank you for having me here.
Let's take a very quick break. When we come back, we'll also recap some of the earnings we're watching out for.